I'm Kyle Hill, one of the partners at Diversified. Over the next few minutes, I'll provide an overview of the global financial markets and our perspective on them. Equity and fixed income markets around the globe delivered above-average performance in 2019. U.S. stocks led for the fourth quarter and the full year, as measured by the S&P 500 index, maintaining the dominance that they showed for the full decade. Globally, stocks performed well during the fourth quarter, as measured by the MSCI ACWI Index, but trailed the U.S. Emerging market equities played catch-up, ranking as the fourth quarter's best performer, but trailed the developed world for the year and the decade as a whole. Breaking global stock market returns down to the country level, we can see that the historically strong performance during the fourth quarter and the full year 2019 was broad-based. A large majority of countries participated in the gains and only a handful had losses. Looking at fixed income, U.S. Treasury rates declined across all maturities over the full year. Government bond rates generally followed suit around the rest of the developed world. During the fourth quarter, however, short-term U.S. rates fell while long-term rates rose, resulting in a steeper yield curve. This reversal in the direction of long-term rates came after the 30-year Treasury rate fell to its lowest ever level during the third quarter. Since bond yields and prices move in opposite directions, falling rates over the course of 2019 helped propel many areas of the bond market to positive performance. Moreover, the combination of falling rates and a healthy appetite among investors meant that the riskiest segments of the fixed income universe, high-yield bonds and emerging market debt, led the way. U.S. investment-grade corporates were also notable performance in 2019. Looking at the big picture for the year ahead, we expect the U.S. and global economies to continue growing, but at a sluggish pace. This should keep inflation under control and encourage central banks to remain accommodative. Altogether, this scenario should be positive for risk assets. Of course, equities and other risky assets are not always well correlated with the fundamentals in the short term. Investor expectations can change much more quickly and far more dramatically than the fundamentals. With that in mind, we'll retain our emphasis on long-term strategic investing over short-term tactical moves. Thank you as always for your trust and confidence.